Thank you so much, Jeremy, for joining us here at the Dwellynn Show. I'm super honored and glad to have you on the show. We saw a few days ago at the Best Ever Conference, Joe's conference. Thank you so much for being here.
Thank you for having me. Really appreciate it.
Yeah, sure. So Jeremy, obviously you're a legend in the industry of apartment syndication. You've done a ton of stuff, but I'm sure you can do a way better job than I can. Just tell the Dwell listeners a little bit more about yourself and kind of what you've been up to lately.
Yeah, sure. So I am a full-time passive cash flow investor. I started investing in cash flow, kind of alternative cash flow opportunities, mostly commercial real estate that are managed or syndicated, where they're pooling a lot of investors together, all passive, in 2002. That was in response to, I was kind of sick and tired of the lack of predictability and the volatility of the stock market after the dot-com crash. So for those of you who remember that. And then I ended up rotating all my money out of stocks and bonds into cash flow between 2002 and 2007. And the cash flow actually got me out of the corporate world in 2007. So I've been investing in kind of like, these alternative type cash flow opportunities since 2002, which is 17 years now. But I've been a full-time passive cash flow investor for about 11 and a half years, so since mid-2007. I'm currently invested in over 70 different opportunities. I've been in over 100 for sure over time. I'm hyper-diversified, and I invest all across the U.S., a little bit in Canada. I'm originally from Montreal. A little more background on me in general, which is I'm from Montreal. I have an MBA from the Wharton School in Philadelphia. I spent over 10 years in the corporate world. Last couple of jobs were with Toyota headquarters and Disney headquarters. So I have a lot of corporate experience, mostly in marketing, a little bit in finance. I've also co-founded something called For Investors by Investors, or FIBI, which is public real estate meetings in California mostly. We are a nonprofit. We actually lose money every year, and the whole focus of it is that we have no sales pitches. We're adamant about, we started it because I was kind of turned off by all the sales pitches I was going to. And so we actually have the largest series of public and non-institutional real estate meetings in California now. We have over 27,000 members and multiple chapters, mostly in Southern California. I'm also an advisor for Realty Mogul, which is, I think, the largest U.S. crowdfunding real estate website. And I've been an advisor for them since before they launched, which is back in 2013. I also manage a private investor group of my own, which is a similar profile to my own personal cash flow type opportunities. I think, there's actually over 1,400 people now in that group. So that's a very quick background on me.
Yeah, thank you so much, Jeremy. There's a lot of stuff in there, but there was this particular recurring theme or term that you kept mentioning, passive. And of course, this was discussed at the Best Ever Conference this past Saturday. So can you just kind of tell our Dwell listeners a little bit more about the modes of investing, the passive and active, and why did you choose the passive route?
Absolutely. So great question. Now, I'm not giving a dictionary definition. I'm telling you my own definition. So for me, I consider somebody passive if they do not have control. And basically, I like to tell people I trade control for diversification. That's kind of the way I see passive investing. So someone who may buy a single family home and have someone else manage it and they just get a cash flow check, they may think of themselves as passive, but to me, they're active because they have control over the property. They can sell it anytime they want. They can hire and fire the property manager. If a toilet has to be replaced, they're going to get a call to approve it. They can, select the tenant and everything else. So to me, that's active. Passive is truly when you're giving control to somebody else. And so it's very different in terms of how you invest and then, what the work you do up front versus ongoing. I got into passive back in 2002 because I was very busy. I was actually working at Disney headquarters and I was very, very busy. And I did not have the time to really be active. My job was very, very busy. So I started on that path and I got really comfortable with that path. And so I just, to today, continue to invest passively. I do find that passive versus active is often a question of personality fit. So some people like having control and they're never really going to be comfortable being completely passive. Other people don't have time. They're completely comfortable being passive. They want to leverage someone else's experience, credit, time, work, etc. And they're more than happy to be passive, which is where I fit. But I will say, though, that I think it's imperative that whoever is considering being active or passive, make sure it's the right personality fit for them. That's very, very important.
Yeah, thank you so much for bringing that up. That's super important. So you mentioned, you had your MBA from Wharton, then you worked, with Disney, with Toyota. So, some folks are thinking, well, like if I had an MBA from a Ivy League like Wharton or Harvard, why would I just not stay in the corporate world and just, enjoy the benefits in quotes of the corporate world? What would you say to that person?
So a couple of things. First of all, I had some great jobs in the corporate world, no doubt. I was very lucky, but I would often sit behind my desk and say to myself, like, there's something missing here. Like, I'm not maximizing my potential. That maximizing of my potential always bothered me. I was one person in an organization of 10,000. Not to say that I wasn't having an effect, but I just never felt like I was maximizing my potential. And so now the fact that I ended up as a full-time passive cash flow investor is something I never would have been able to project from the start. But the point is that now I feel like I'm maximizing my potential. I'm really doing what I want to do. And so if you're in the corporate world right now and you're not happy with your job, whether it's passive cash flow investing, active investing, or anything else, strongly recommend that you consider thinking about doing something else, because I know the majority of people statistically are not happy with their jobs, but I'm very happy with my job. And another thing I'll say is that I'm very lucky because I discovered passive cash flow. And I don't want to sound like an infomercial. This is not like, I'm not trying to sell anybody anything, but it changed my life completely. I got out of the corporate world from the cash flow. I live off the cash flow. In fact, we were just talking before I started the interview. I literally broke 2 ribs this weekend. Unfortunately, I fell. I was in a conference in Denver, fell in the snow on the street. And I can't really drive right now, but I have all the flexibility in the world that if I want to stop working for 2 weeks and relax, which I'm not going to do, but I could, if, I have to reschedule some stuff because I can't move around very well, I have all that flexibility, whereas that could have caused a problem for somebody else in the corporate world. So the freedom to do what I want and the fact that the cash flows enable that is just a huge, huge benefit from my perspective. So there's a couple different angles on my answer, but in the end of the day, getting out of the corporate world and having the cash flow has just changed my life in many ways for the better. That being said, if somebody wants to go up the corporate ladder, it's the right fit for them, and they have a really good degree or a good job, there's absolutely nothing wrong with it. It's just that I've kind of found the perfect fit for myself.
Thank you so much for sharing that. So one more last question, kind of piggybacking off of that. So you wanted to maximize obviously yourself and, do better. But you could have chosen any other asset class, right? You could have managed a hedge fund, for example, or whatever, but you chose real estate, right? So you've kind of mentioned a little bit, the volatility of the stock market, but just why real estate? I know you mentioned the passivity of it. Just go a little bit more deep into that.
Yeah, and I would say that I do invest across all different types of things, but by far the most common investment I make is actually specifically even commercial real estate, which I include multifamily in that. And the reason why is because I'm a huge fan of kind of being lower risk, and therefore I love tenant diversification. So for example, I would feel much more comfortable being in a 200-unit apartment building that's 100% occupied than one home that has one tenant that's 100% occupied. So that's where my head goes to. And so for me, commercial real estate can provide big benefits from a diversification perspective, from a tenant diversification perspective. If you're going passive, you can get diversified across a lot of different types. So I'm invested in many different types: mobile home parks, self-storage apartments, student housing apartments, retail strip center, industrial, and others, office and others. And so I love the concept of being diversified. When I get diversified, to me, diversification has 3 very important components in real estate. I want to be diversified across asset classes, geographies, and operators. All 3 when I'm passive. And geographies is key. I may invest in a self-storage property in Florida, and there may be a hurricane. I'm less concerned about it because there aren't very many windows, not much going to get damaged. Whereas, I may be reticent to invest in something in earthquakes in Southern California, but I can avoid that by being somewhere else. And by being passive, I have a lot more choice for that because there's just a world of choice out there when you're passive versus active. It's much harder when you're active. But in any event, and so I am a very, very big fan of diversification, and therefore commercial real estate ended up being a very good fit for me. One more thing I'll say about commercial real estate is that very commonly when you're looking at a commercial real estate deal, if you're passive, it's going to be with someone who's experienced, either comes from the industry or has many years of experience working on that asset class, and you get to leverage someone else's experience, credit to get a huge loan, and many other great things you can leverage. And finally, as a passive cash flow investor, I get the benefit of having depreciation and expense flow through. So for those of you who don't understand what that means, essentially I'm able to defer a lot of taxes because I get to deduct depreciation and expenses from my income. And very often I'll get a cash flow checks from a property for a year. And let's say my cash flow is 5,000 from property for a year. The taxes that I owe that year may be zero, literally, as a result of the depreciation and expenses. Now, it's not that I owe zero taxes on that forever. It's just deferred till the end. And then even at the end, the way that they claw it back is at a favorable rate. And so a lot of the tax code is actually it was designed to benefit real estate investors. And I get to participate in those benefits as a passive investor, or even if you're going to be an active investor, no matter which way you do it. And so real estate has a lot of tax advantages that a lot of people probably aren't aware of if they don't invest in real estate.
So another thing that somebody might be thinking of is, wow, I've got a 9-to-5 job like Jeremy used to have, and I've always thought that I have to start active. I have to buy a small house and then another small house and another small house. It looks like you kind of just went in straight away. You kind of went big, so to speak. So for those thinking about going down that path, I love what you said about diversification across, syndicators, across geographies, across asset classes. What would you say to somebody that is just starting fresh? Maybe they're frustrated with the ups and downs of the market, and they're looking to, maybe move some of their 401k or IRA and start investing passively. What do they have to look out for?
Yeah, I mean, that we could talk for like 3 hours about that, but here's what I'll say. I'll give a couple of things that are very important. We're at the beginning of 2019 that we're recording this right now. Number one thing I would say to somebody is be very careful right now. I am a very conservative person, so I'm a little bit biased, but I will say I think we're kind of at the end of a cycle, and that means that prices are very high. It's a very dangerous time to invest just from a pricing perspective. So it's a great time to learn if you're brand new. You're not missing out on much if you learn right now and don't necessarily move forward. But from my perspective, just be very, very careful and understand that real estate is cyclical. It goes up, it comes down, especially commercial real estate. And you're going to want to be careful because timing is very important. So that's number one. Number two is that if you're going to start off from scratch, I'd recommend, rather than trying to learn all these different asset classes I mentioned, start off trying to learn one. And I would say that the number one, the easiest one to probably get your arms around, at least most people I think believe this, is apartments. Start with apartments. You could probably relate to them. You may have rented an apartment in the past, and it's just a lot easier to analyze, for example, than a self-storage facility or a mobile home park for various other reasons. And so I would start by trying to learn a single asset class, and what you'll be surprised to learn is that you can actually transfer the knowledge of a single asset class onto most other asset classes. From a revenue and expense perspective, there's a lot of expenses that are similar across properties. There's certain expense ratios that you can look at. There's certain assumptions and everything else that apply across all different types of properties, like a revenue growth, a multiple of net operating income for exit. All these things you eventually learn, you can actually transfer across all the asset classes. But start on one, don't overcomplicate it, and start on the one you understand best. So it might be apartments, it may be something else. The most common one that people understand best is typically apartments starting.
All right. One more question before we start wrapping up here. So obviously you've worked with a few syndicators or sponsors. If there's a Dwell listener out there thinking of, oh, okay, I like what Jeremy's saying. Do I want to be kind of careful around this time of the of the market cycle? But maybe when I'm ready, I'll start looking out for syndicators, sponsors in the marketplace. How can I find a good sponsor? How do I vet or basically get with a good sponsor?
Yeah, great question. So, God, that's also a very long answer. What I will say is that when you're trying to find a sponsor, one good way is to network and ask people who they've invested with. Have they had a good experience? That's number one. Also, keep in mind that at least in my opinion, that the sponsor, if you're going to invest passively in a deal, the sponsor is actually even more important than the opportunity itself. I like to give the example to people that, I live a few blocks south of Beverly Hills in Los Angeles, and a lot of people know Rodeo Drive and, famous street. And so I like to tell people, you can invest in the best building, in the best location of Rodeo Drive with the best tenants. But if you have an operator or sponsor who just runs the building into the ground, all the tenants are going to leave. You're going to hand the keys back to the bank, and it didn't matter that you had the best building, the best location. So to me, the number one thing when you're looking at these opportunities is who you're making a bet on, which is a sponsor. And number two thing is the actual property itself, albeit that the property is very important. And so you really want to focus on evaluating the sponsor. Are they the right type of personality you want to invest in? Are they conservative? Are they using conservative assumptions to be able to overperform and over deliver for investors to build long-term relationships with them? Or are they using aggressive assumptions to make the numbers look really good, to market their deal to people, to find investors and attract them with these high projections, and not really caring as much about how they perform because they're going to get certain fees and everything else, and they're just going to move on to the next investor. So, but finding the sponsors, you've got to do a lot of networking. It's good to ask around, see who other people have invested with and who they recommend or not recommend. And of course, you're going to have to evaluate them yourself regardless.
All right. So I think I lied. One more last question. So what would you consider a really, really good deal? It could be an apartment building deal. It could be, any other asset classes that you really, really liked. It could be maybe you made a lot of money or you helped someone or just a really memorable deal for you.
Yes. So would you prefer that it's actually on a total gain or a cash flow situation, or what type of?
We can do both.
Many deals, so I can pick.
We can do both.
Okay. So from we talked about timing. So from a gain perspective, back in 2005, I invested in a 2-story office building in Calgary, Canada. And it was kind of like a typical medical office building, meaning it's mostly doctors and dentists, et cetera. We bought the building for cash flow, got it at a pretty good price. And I was just looking forward to it cash flowing really well, hopefully. A sponsor that I've invested with many times now, over 20 times actually. And long story short is that because we bought it at that particular timing of the cycle, within, I think, 1 to 2 years, we were actually planning on redoing some of the elevators and some, spending some money on it, but we hadn't gotten to there yet. And we bought the building at $5.5 million, and we sold it about 1.5 years, 2 years later at $12 million. And the thing is, if you're familiar with real estate, with leverage, with the loan, I mean, that's not just a 2.2 or 2.5 return. It's much higher than that. So that ended up being just very lucky, but also a sponsor that had to recognize that it made sense to exit. Even though we went in for cash flow, they were flexible enough to say, we got a deal we can't refuse, we got to leave, even though we were supposed to be in this for 10 years and provide cash flow for investors. This is actually an even better end result for investors. We're going to pivot and sell the building. So that was one great thing, all to do with timing, okay? That's from a gain perspective. And by the way, I can give you other stories that are not real estate related where the gains are much higher, but that's a different story. On cash flow, so there's a 2-park mobile home park portfolio that I invested in with an operator in the fall of 2017. And it was in Alabama. We got really favorable pricing. I think we got better than 100 basis points better than market rates and the cap rates. And I think it was about 20 vacant, I'm just rounding it out, because about 20 vacant lots on 200 lots, say. And so it was 90% occupied. Well, since we started, rents have increased. They've brought 10 homes in already, way ahead of plan in terms of, increasing the occupancy rate. And I think we already are up to mid-teens distributions. So in other words, we're already hitting about 15% cash flow. Again, I think it was 14, but we're actually about to property value is actually, we bought it so well. We bought it at, I think, 6.7 million, and we just got an offer for like 10.5 million a year and a half later. But they don't want to sell it. They actually want to keep it for cash flows. They're going to refinance it. So I think we're going to pull out like 40 or 50% of our cash and continue to get low teens cash flow going forward on the original investment. So, and that has to do with performance of the operator, but also buying something particularly right, especially at a time where I think the valuation is even more important because you got to be even more careful right now. So that's kind of a story that, here's some great cash flow because we bought it right. And because we bought it right, we can refinance it. Because they're operating it really well, we can refinance it well. And it's going to continue to cash flow well for a really long time, hopefully. So those are just two. I have many different.
I bet you do. Yeah, but we definitely dwelling into the quick rounds. These are going to be quick questions, quick answer. Yep. You ready, sir?
Yes, I'm ready.
All right. First question. What makes Jeremy unique? What is that differentiating factor that separates you from the next guy or from the next girl?
I am very patient and very persistent. I am willing to think about where I'm going to be in 10, 20, 30 years from now and just slowly but surely get to that plan and literally just have the patience of knowing that I'm going to get there in 20 years. I'm not looking to like have an overnight quick return. I'm happy to, but I am also very, very persistent to focus on it and very persistent in general. I will follow up and be very organized to follow up. And I think that, to an extreme, which is very helpful in business. So
it's never about the lead, right? It's always about the follow-up. I heard that once said.
Yes, that's very true. Very true.
Yep. So next question. What was the last book that you read? And what was the one thing that you picked up from that book?
Yeah. So I don't read very many books. I do listen to a lot of books on tape, is not right. I listen to a lot of YouTube. Some of them are books and some of them are more just speeches. So Jim Rohn is actually someone I just listened to this morning. Cannot recommend him enough. For those of you who have never listened to him, his last name's Rohn, like Nancy. Just a treasure trove of learning, like just the wisdom that he actually is one of my favorite speakers too. The way he delivers is so great. And God, I mean, the amount of advice that he gives, I am having trouble even picking one from him, just because, in fact, this morning I heard, he mentioned that the number one thing that guides your ability to succeed or fail in life is your discipline. And that was what I was listening to from him this morning. But he has so many good quotes. It's crazy. I mean, what you can get from him in just 20 minutes is truly unbelievable in terms of the amount of wisdom.
Yeah, Jim Rohn is a legend, true legend.
Yeah.
Final question. You've got, all your investments going, and of course you got family, you're speaking at different events. I heard you speak this past weekend. What do you do for fun?
Well, I'm focused right now on my kids. So it's funny, you mentioned we were at the conference this weekend. I try not to go to that many conferences now, especially out of state, because I just try to I work from home. It's one of the things we talked about before, because I work for myself and I got the cash flow, I can work from home. I get to see my kids when they come home from school every day, literally 2:30, 3 o'clock, I get to see them. And my focus is on spending as much time as possible with them because they're growing up very quickly. So otherwise, I am a car guy. My last job was actually at Toyota headquarters, so I'm a big car guy. And a couple other things too, but mostly focus on my kids right now.
Awesome. I mean, I have almost an unusual listenership in California. So if there's a Dwell listener listening on a conversation and thinking, wow, I want to, connect with Jeremy, I want to get to know him, maybe go to one of your events, what's the best way we can reach out to you?
Sure. Yeah, a couple of things. So one is, the best way to reach me personally is just email. So my email is jroll, JROLL, @Roll Investments, ROLL Investments with an S.com. So jroll@rollinvestments.com. Feel free to, anybody is welcome to contact me. If there's any way I can help anybody, feel free to contact me. Because you have a lot of listeners in California, if you'd like to come to one of our foreign investors, buy investors events, we're a nonprofit organization. We literally lose money every year, but hopefully we're helping people to network in a no sales pitch environment. Go onto meetup.com and just type in FIBI or Phoebe in the search box. You'll find all our meetings. There may be one close to you. We're mostly in Southern California, so if you're in Southern California, that's probably the best fit. I am not in most of our events for the reason I mentioned in terms of being with my kids, but I do go to our semi-annual all-chapter networking event. That's just a big networking room. We typically get 150 to 250 people at those events. They're in June and December. Otherwise, you'll find all our chapters are different. Some of them are panel discussions, some of them are individual speakers. Check them out. Take a look at, don't go unless it's a good fit in terms of topic, but most of our meetings will get between 40 and 100 people there each time. So it's a really good place and great networking.
Wow. Thank you so much for sharing that, Jeremy. I really appreciate you. And thank you for being here. Thank you so much.
No problem. Thank you for having me. Hopefully this episode will be helpful for some of your listeners.
Sure will be. Thank you.
Thanks.